My name is Aida, and I'm joined today by my colleagues Nick. Hi, Nick. Roanne. Hi, Roanne, and Juliana. All of us working together on delivering this project, together with some other colleagues who are not here with us today. So in this webinar, we're going to give you an update on the status of the project, and we're going to cover both the proposals that were in the IASB's exposure draft published at the end of 2019, as well as a result of redeliberations so far on the project. Finally, I just want to mention a few things on the housekeeping items before we get started. Just that note that you will be able to see the recording as well as the slides we used today on our website and YouTube channels. And also to encourage you, please submit your questions as we go through the presentation. We plan to pause for questions after every section, and we're also going to leave some time for questions at the end. And the final point here is just to note that the views you hear today are our own views, not necessarily views of the IASB or the IFRS Foundation. So with that, let's just look at the project overview. So the primary financial statements project was on the top of the users list in the IASB's 2015 agenda consultation, and we have been working hard at it since. So reminder of the project objective, you can see here on the slide, is to improve communication in the financial statements with a focus on information in the statement of profit or loss. There are three main parts to the project. You can see here on the right-hand side, first, additional required defined subtotals in the statement of profit or loss, which Roanne is going to run us through shortly. Second, disclosures about management performance measures, which Nick will walk us through. And thirdly, a series of requirements intended to improve the segregation of information in the financial statements, which Juliana is going to walk us through. Now, just to note, the feedback on the 2019 exposure draft was extremely supportive of the project and the IASB continuing and finalizing the proposals. And IASB has indeed concluded redeliberations of the main aspects of the proposals. However, we haven't quite finished everything. So just to help you navigate through this, as we walk through the slides, we have included some coding in the proposals. So you will see some red stars and some blue stars. Some red stars mean these are the proposals that the IASB is still to redeliberate. And blue star means these are the proposals that are subject to targeted outreach, which we have just about started last week. So a few words about the targeted outreach. So this is exercise we're doing now with the objective to test whether the proposed changes compared to what was in the exposure draft are going to work as intended, and to make sure that the overall balance of cost and benefits is right. So the IASB is planning to discuss the findings from this targeted outreach early 2023, and then IASB is planning to conclude redeliberations on the project. So with this quick overview, I think, Roanne, would you like to walk us through the proposals for the subtotals in the statement of profit or loss?
Thanks very much, Aida. So before we discuss the proposals, let's go through the issues that the IASB is addressing with regards to subtotals. IS1 requires the presentation of a revenue line item and a profit or loss total, but no specific subtotals in between. During the development of the exposure draft, we analysed the financial statements of a sample of 100 entities reporting under IFRS accounting standards. In the statement of profit or loss, we found similarities in the labels of subtotals presented, but a high degree of diversity in how those subtotals were calculated. For example, 63 of the entities reviewed reported an operating profit subtotal. However, we observed at least 9 different definitions for what was included in operating profit. We also noted that around a third of entities included share of profit or loss of associates in joint ventures accounted for using the equity method in operating profit, while the rest did not. And around a quarter of entities included the interest cost on defined benefit liabilities in operating profit. Around half of them classified it outside operating profit, and it was unclear where it was included for the remaining quarter of entities. So to address this diversity in practice, the IASB is proposing to introduce in the statement of profit or loss 2 new subtotals, which are operating profit and profit before financing and income tax, and 3 categories so for classifying income and expenses, which are operating, investing, and financing. So firstly, what's in the operating category? The operating category would be defined as a default category. So that's anything that does not meet the requirements to be classified in the investing or financing categories. Defining the operating category in this way means it will include, but is not limited to, all income and expenses from an entity's main business activities, and it will also capture everything that results from an entity's operations, including volatile and unusual income and expenses. An indirect approach to defining operating profit works well with different business models and is simpler to apply than a direct definition, which may require significant judgment to apply. It also avoids the need to create a non-operating category that is neither operating, investing, or financing that may be used opportunistically. So next, what's in the investing category? The investing category would include income and expenses from associates in joint ventures accounted for using the equity method, and income and expenses from assets that generate a return individually and largely independently of other resources held by an entity, including cash and cash equivalents. You may recall from the exposure draft, it had proposed to distinguish between integral and non-integral associates in joint ventures. And in the redeliberations, the IASB has decided not to proceed with this proposal because overall there was not much support from stakeholders, and fieldwork indicated significant difficulties with the proposed requirements. So instead, the IASB has tentatively decided to require an entity to classify income and expenses from associates and joint ventures accounted for using the equity method in the investing category. This is because there was strong support from users for these income and expenses to be classified outside of operating profit. The investing category would also include income and expenses from assets that generate a return individually and largely independently of other resources held by the entity. Examples of such income and expenses are rental income and remeasurements of investment property, interest income and fair value changes on financial assets, and dividends received. These income and expenses are classified in the investing category unless the entity invests in those assets as a main business activity, which we'll cover on a later slide. You may recall the proposal in the exposure draft was to classify income and expenses from cash and cash equivalents in the financing category, and in the redeliberations, the IASB has tentatively decided to classify them in the investing category. And by classifying them in the investing category, it makes the structure of the statement of profit or loss simple because the investing category would include income and expenses from assets, and the financing category would generally include income and expenses from liabilities. The exposure draft proposed that incremental expenses also be classified in the investing category. In light of the feedback from stakeholders, the IASB tentatively decided to withdraw this proposal. And next, what is in the financing category? So the exposure draft proposed that an entity classify in the financing category income and expenses from liabilities that arise from financing activities so that an entity's performance can be analysed independently of how it is financed. The exposure draft also proposed that interest expense on liabilities, such as decommissioning provisions and defined benefit liabilities, should be classified in the financing category. There are different views on whether such interest expense should be classified as operating or financing. The IASB's proposal to classify these income and expenses in the financing category provides a consistent basis for their presentation. Respondents to the exposure draft agreed with introducing a financing category, but some of them said that aspects of the proposed definition of liabilities arising from financing activities were unclear. So in the redeliberations, the IASB made changes to the proposed approach for classifying income and expenses within the financing category. The objective of the change is to make the proposals easier to apply, and they are not expected to result in a change in income and expenses that will be classified in the financing category, but they are expected to result in a change in the way income and expenses are classified within the financing category for interest expenses on lease liabilities and amounts payable for goods and services received. The IASB will be testing these changes in its targeted outreach. So how will income and expenses be classified in the financing category? Applying the IASB's tentative decisions in the redeliberations, the financing category would include all income and expenses from liabilities that involve only the raising of financing and specified income and expenses from other liabilities. So all income and expenses from liabilities that involve only the raising of financing are income and expenses from a transaction that involves the receipt by the entity of cash, an entity's own equity instruments, or a reduction in a financial liability, and the return by the entity of cash or an entity's own equity instruments. For example, a loan contract is a transaction that involves the receipt by the entity of cash and the return by the entity of cash. So a transaction which exchanges cash for cash, so it's a transaction which involves only the raising of financing. A lease liability is an exchange of a right-of-use asset for cash, so it's not a transaction which involves only the raising of financing. For other liabilities that do not involve only the raising of financing, such as decommissioning provisions, defined benefit liabilities and lease liabilities, an entity would classify interest expense and the effects of changes on interest rates in the financing category when such amounts are identified applying the requirements of IFRS accounting standards, such as IFRS 16, IAS 19, and IAS 37. And next, entities with specified main business activities. Operating profit is intended to include key metrics of operating performance. Applying the proposals just discussed, entities such as banks would classify interest expense on loans they use to finance their operations in the financing category. This would mean that they could not present a key operating metric of net interest income in the operating category. Therefore, the exposure draft also proposed requirements for entities with specified main business activities. So that's entities that invest or provide financing to customers as a main business activity, to classify income and expenses in the operating category that would otherwise be classified in the investing or financing categories. For entities that provide financing to customers as a main business activity, these entities may include banks and entities that provide financing to customers to purchase an entity's products. The exposure draft proposed an accounting policy choice for entities that provide financing to customers as a main business activity to classify in the operating category all income and expenses from financing activities and cash equivalents, or the portion related to providing financing to customers. I will explain about cash and cash equivalents for entities with specified main business activities on the next slide. Some stakeholders had raised concerns that the requirement for classifying income and expenses from financing activities had been formulated as an accounting policy choice. In the redeliberations, the IASB considered and rejected other approaches as they were not viable alternatives to the accounting policy choice. Given the proposed changes to the financing category just discussed, in the redeliberations, the IASB has decided that an entity that provides financing to customers as a main business activity will have an accounting policy choice to classify in the operating category either all income and expenses from transactions that involve only the raising of financing, or the portion of these income and expenses related to providing financing to customers. As proposed in the exposure draft and confirmed in the redeliberations, the accounting policy choice is not applied to specified income and expenses from other liabilities. Entities that provide financing to customers as a main business activity would classify them in the financing category, the same as all other entities. As a result of the tentative decisions on the financing category, interest expense on lease liabilities and amounts payable for goods and services received are now captured by specified income and expenses from other liabilities and no longer subject to the accounting policy choice for entities that provide financing to customers as a main business activity. And finally, entities that invest as a main business activity may include insurers, investment entities, and investment property companies. The exposure draft proposed that entities would classify income and expenses from assets that generate a return individually and largely independently of other resources held by an entity in the operating category when the investment is made in the course of an entity's main business activities. To address the feedback from stakeholders requesting clarity on what the board had meant by invests in the course of main business activities and how it differs to as a main business activity used in the financing category, the IASB has tentatively decided to change it to invests as a main business activity. The proposed change is expected to retain the outcome for those entities, such as insurance entities, that in the course of was introduced to capture, and having a consistent concept for the investing and financing categories will make the proposals easier to apply. As proposed in the exposure draft and confirmed by the IASB in its redeliberations, this requirement does not apply to income and expenses from associates and joint ventures accounted for using the equity method, which are classified in the investing category by all entities. Similar to the proposal in the exposure draft, entities that invest in financial assets as a main business activity would classify in the operating category income and expenses from cash and cash equivalents. The IASB decided to explore in targeted outreach, withdrawing the accounting policy choice for classifying income and expenses from cash and cash equivalents proposed for entities that provide financing to customers as a main business activity. The reason is that the IASB expects that many entities that provide financing to customers as a main business activity will also invest in financial assets as a main business activity. So for such entities, the requirement to classify in the operating category all income and expenses from cash and cash equivalents would be triggered by their investments in the financial assets and no requirement in relation to providing financing to customers as a main business activity would be needed. So with that, that's all I'd like to say on subtotal. So pause here. Aida, are there any questions you would like us to answer?
Thank you so much, Roanne, and it's quite interesting. The first question is pretty much same as the first question we had this morning, so clearly a topic of interest. So the question is, would results from derivatives be classified in the investing category then?
Okay, so the ED had proposed that income and expenses on derivatives would be classified in the same category affected by the risk it intends to manage, and in certain cases, the income and expenses on derivatives would be classified in the investing category. In the redeliberations, the IASB has tentatively decided to change the default category for derivatives from the investing category to the operating category because it would better reflect risk management, reduce mismatches, and be consistent with your IASB's definition of the operating category as the residual category.
Thank you so much, Roanne, for the explanation of this slight tweak, let's say, to make proposals more even easier to understand and perhaps more logical. Another question that we get here is, we talked about entities with specified main business activities, we talked about general model, but what about those that have it all? What about conglomerates? Could you talk us through how would proposals apply and what could the P&L look like for a conglomerate that has all these activities?
Okay, sure. So Nick, perhaps you would like to move the slides to the profit and loss statement that we have in the slide deck. So an entity is required to assess whether it invests or provides financing to customers as a main business activity. And if an entity invests as in the course of its invests as a main business activity, it would take up the associated income and expenses in the investing category into the operating category. If an entity provides financing to customers as a main business activity, it would as an accounting policy choice, it can either take up all income and expenses from liabilities that arise from transactions that involve only the raising of financing, or the portion related to providing that financing to customers. So for a conglomerate type of entity, we would expect that they would exercise the accounting policy choice to take up just the portion of those income and expenses from liabilities that relate to providing that financing to customers, and then to leave the remaining income and expenses from their liabilities in the financing category.
Thank you so much. So their P&L could look actually quite similar to what Nick is showing us here, with the exception of, the financing, some of the financing category items being in the operating to the extent that it relates to provision of finance, right? Another question that has come is, what about disposals of PP&E and disposals of assets whose income and expenses are in the investing category? Where would such disposals go?
Okay, so income and expenses from assets that are in the investing category, such as associates and joint ventures accounted for using the equity method, those disposal gains would also be classified in the investing category. For property, plant and equipment, which has depreciation expense recognised in the operating category, the disposal gain or loss on those assets would be classified in the operating category.
So very much following the asset, right?
Yes.
So another question that's quite popular, we seem to be getting a top list of hits here. Actually, one has come up. Maybe let's cover that first. So you explained to us classification of derivatives. Do you want to just talk quickly how this relates to Forex classification?
Okay, so the exposure draft had proposed that an entity would classify foreign exchange gains or losses in the same category in the statement of profit or loss as the income and expenses from the items that gave rise to a foreign exchange difference. And a lot of respondents to the exposure draft had disagreed with this proposal on the basis that the costs of applying it would exceed the benefits of it. So in the redeliberations, the IASB tentatively decided that for cases that involve undue cost or effort, an entity would classify foreign exchange gains or losses in the operating category. Several reasons for this. One is that the operating category is the residual category, and classifying foreign exchange differences related to an entity's operations outside of the operating category would result in an incomplete operating profit. So the long and short of it is that the foreign exchange gains and losses will now be classified in the operating category as the default category.
Thank you so much. And another question that's come in is the classification of taxes. So is there any change in classification of income taxes? And what about classification of other taxes?
So below the financing category is actually a category for income taxes, and then all other taxes, if they do not meet any of the requirements to be classified in the investing or financing categories, which usually we would expect they would not, they would be classified in the operating category.
Thank you so much, Roanne. And I do know that we need to move on, but there is one question left that I think lots of our stakeholders are really keen to have the answer to. So IASB has dropped the proposals for integral and non-integral, but could entities still present a subtotal that combines operating profit and some of their associate and JVs income when those are measured using equity method?
So the IASB has decided that income and expenses from associates and joint ventures accounted for using the equity method would be classified in the investing category. And when it provides an understandable overview, an entity could present them directly below the operating profit subtotal, followed by a subtotal of operating profit and income and expenses from investments accounted for using the equity method. It's not a required subtotal, but the entity would be permitted to present that subtotal. If the entity was to use that subtotal in its public communications, it would meet the definition of a management performance measure, which Nick will explain. But the IASB has clarified or decided to make that subtotal a specified subtotal, which means the entity would not be required to provide all the MPM disclosures for it, including the disclosure requirements for tax and NCI.
Thank you so much. And I know many of our stakeholders are very interested in this. But I know we still have a few more questions we haven't had a chance to cover. If there is time at the end, let's come back to those. But now it seems like a good time to hand over to you, Nick, to walk us through proposals for management performance measures.
Great, thank you. Yeah, so the second key part of the proposals are for management performance measures. And again, let's start with the issue that management performance measures are trying to address. Now, we know many entities today provide a variety of management performance measures or management defined performance measures, such as adjusted profit. And what we found in our research was no different. In fact, most entities disclose some type of management defined measure. And the slide shows here some of the more popular ones that we found. Our research also showed that some entities provide detailed reconciliations for these measures, but some provide limited reconciliations, and a few even have no reconciliations at all. Now, the message around management defined measures that the IASB heard from investors was that such measures are useful because they can provide insight into how a management views the company's performance, how the business is managed, and the persistence or sustainability of the financial performance. But users also had some concerns. For one, they said that often management defined measures are not transparent. They can sometimes be difficult to find, and sometimes they change from one period to another. So given the usefulness of the information of this non-GAAP information, the IASB thought it was important to bring transparency and discipline in the disclosure of the measures. And it's therefore proposing to define a subset of such measures as management performance measures and require their disclosure in the financial statements. So what is that subset? The initial feedback from users on the primary financial statements project as a whole led the IASB to focus the proposals in the exposure draft on the reporting of financial performance in the statement of profit or loss and the related notes. So consistent with this scope, management performance measures are proposed to include subtotals of the income and expenses. Now, this limits the scope of management performance measures to a subset of the non-GAAP information that we see today. And this is consistent with the focus of the project being the statement of profit or loss. Now, in the exposure draft, there was strong stakeholder support for the management performance measure proposals. And in fact, some wanted the scope of the proposals to be expanded to include a wider set of measures with various suggestions on the types of measures, such as things based on the statement of financial position or the cash flow statement. The IASB considered expanding the scope of the management performance measures in its redeliberations, acknowledging that there would be value in the information that would be provided by including a wider set of measures. But after much discussion, it decided that the work needed to make sure the definition would capture the right population, that the disclosure requirements would maintain that transparency and discipline that's desired, and that the interaction with other IFRS standards could be addressed. There was a significant risk of delay to other aspects of the proposals. And so this link to the project objective was maintained. So as a result of the IASB's decisions, it did decide to make a small change to the scope to include subtotals of income and expenses that are used within a ratio. So only the subtotal would become a management performance measure if it met the definition, but not the entirety of the ratio. So this still means that many non-GAAP measures that are commonly used today will not be management performance measures. Any measures, for example, based on the statement of financial position or cash flows, individual items, or performance measures that are ratios as a whole would not be included. So the definition that gets us this population is on the slide that we see here, and it includes three key elements. The first being, as I mentioned, it's a subtotal of income and expenses that is not specified within IFRS accounting standards. This again provides that link to the project objective. The second piece is that it communicates management's view of an aspect of an entity's financial performance, and providing this insight was one of the key reasons users said that these measures were useful. And then finally, it's a measure that's included in public communications outside the financial statements. And this is to promote consistency with those measures reported in the financial statements and those communications outside, such as management commentary, press releases, or things like investor presentations. Now, in the original proposal, there was no further guidance on what would be included within public communications. So in response to feedback that term could be interpreted quite widely, the IASB has tentatively decided to exclude oral communications, transcripts, and social media posts from the scope of public communications, as these were the types of communications stakeholders said were the most problematic. Now, there's a tension between the two second parts of this definition, and that was reflected in the feedback to the exposure draft. On one hand, to get consistency in the performance measures being reported in the financial statements, and the other communications, there needed to be a fairly wide scope for what is captured, this public communications. But on the other hand, we receive feedback that not every performance measure that an entity publishes necessarily represents management's view. For example, an entity may not view its business using a certain measure, but that measure may be required by a regulator. Some also had concerns that what constitutes management's view could be quite subjective and potentially undermine the purpose of management performance measures. So to balance providing the useful information and responding to these concerns, the IASB has tentatively decided to add a rebuttable presumption. So if a measure that is communicated in the public, it's presumed to communicate management's view. And if it meets the other parts of the definition, it would be a management performance measure. Now, an entity could rebut that presumption with reasonable and supportable evidence that was contrary if that wasn't the case, such as in the example that I mentioned of a regulatory requirement to present something. So whether this rebuttable presumption will work as intended is one of the topics that we will be addressing in the stakeholder feedback. Outside the definition, there are no specific restrictions on what a management performance can be. So a measure that could include adjustments that are not measured in accordance with IFRS standards. Now, that doesn't mean that there are no limits on what a management performance measure can be. The IASB included a requirement that management performance measures must be described in a clear and understandable manner that does not mislead users. And the IASB has noted that being in the financial statements means that the general requirements such as relevance and faithful representation would still apply. The IASB has gone on to propose a number of disclosure requirements to bring further transparency and discipline around the measures. So let's have a look at what those disclosure requirements are. So first, companies would be required to provide the disclosures in a single note so that there is a single location for users to find this information, and it includes all of the information required to understand the measure is included together with that measure. The next and probably most important requirement is that the management performance measure would be required to be reconciled to the most directly comparable total or subtotal specified by IFRS accounting standards. Now, this immediately gives a level of transparency and helps users to relate how the management performance measure connects to the financial statements. Also, during the redeliberations, the IASB tentatively decided to enhance this transparency by adding a requirement to identify the line items in the statement of financial performance to which the adjustments relate. So from our research and experience in the field work, we identified there were different ways to do reconciliations. Some of those ways provided better information than others. But rather than prescribe a certain method for the reconciliation, the IASB decided to require in the reconciliation a link between the reconciling items and the statement of profit or loss. As part of the reconciliation, an entity would also be required to disclose the tax and the non-controlling interest for each adjusting item in the reconciliation. This gives users the information that they would need to better understand the individual impacts of the adjusting items. Users have told us that this is necessary to understand the impact, as tax can include a substantial portion of the change. It is also necessary for them to be able to revise a measure and understand the impacts on a per share basis. Now, in response to feedback that calculating the tax effects for an individual item may be costly, the IASB is proposing a simplified approach for calculating the income tax effect. And this would be based on the tax effects of the underlying transaction in the using the statutory rates applicable to the transactions in the relevant jurisdictions. An entity would also be able to choose to allocate other tax effects on those items on a basis of a reasonable pro rata allocation, similar to what was included in the exposure draft. Again, this is one of the topics that we will be exploring in the targeted outreach to test whether the balance of information is justifies the costs. Another aspect of the transparency for management performance measure is the requirement to disclose why the management performance measure communicates management's view. And this includes an explanation how the measure is calculated and why it provides useful information. So a brief example of what a reconciliation might look like. A fairly simplified example, but it serves to show the link between the statement of profit or loss and the individual measures, in this case done by a narrative disclosure next to the line items. This showing the tax and non-controlling interest, how this might be shown in a columnar format. and showing how it's reconciled directly to a specified subtotal within IFRS accounting standards. Now, those subtotals will include those totals and subtotals carried over from IAS 1, the new subtotals proposed in this project, but the board has also specified 3 subtotals that it has defined. The first is subtotals similar to gross profit, and this is described as the difference between the type of revenue and the directly related expenses incurred in generating that revenue. The next is operating profit, income and expenses from investments accounted for using the equity method, which Roanne referred to earlier. And the final one is operating profit before depreciation, amortization, and specified impairments. Now, a brief word on EBITDA as that relates to this final subtotal that I mentioned. As the board discussed EBITDA throughout the project, it noted that some see EBITDA as nothing more than operating profit as defined in the project, but before the deduction of depreciation, amortization, and impairment. Now, the IASB thought that in such cases, all the disclosure requirements for a management performance measure would not be useful, and so this has been a specified subtotal, meaning it would not be a management performance measure, the disclosures would not be required, but it would also be a measure that could be reconciled to. The IASB has said it will not explicitly prohibit EBITDA as a label for this subtotal, but will clarify in the basis for conclusions that such a label would rarely be a faithful representation of it. So before moving on to disaggregation, we'll pause here for some questions around management performance measures.
Thank you so much, Nick. And we have some questions coming in here, and please submit any more that you might like to ask Nick. But the first question is, again, one of our top list questions we receive, and it relates to presentation of management performance measures in the statement of profit or loss. So we talked about how there's no restriction on how MPM is calculated, but is there any restriction on what MPMs can be presented in the statement of profit or loss?
Yes, so as you say, that is a popular question. And there was some, for those of you that have seen the exposure draft, there was some guidance in there that saying that a subtotal included in the statement of profit or loss could be a management performance measure. So in some cases it can fit. It would, however, be required to fit within the structure, so meaning fitting within the categories that have been explained today. It would also need to meet those requirements that we've talked about of relevance and faithful representation. And in the case of something that's in the statement of profit or loss, it would be required to be calculated in accordance with IFRS accounting standards. So not anything could be on the face, and in fact, those restrictions may limit what can be there, but some could, in fact, if they meet those criteria, be there.
Thank you so much, Nick. And another question has come up in relation to audit of management performance measures. So bringing them in the scope of financial statements would make them subject to audit requirements, but they are by definition measures defined by management. So what do you expect the audit of these measures to be like?
Well, we expect that the transparency that's given around the disclosure should go some way to giving the information required to audit. We also see that similar type measures are used within IFRS 8 today, and would expect that in a similar vein, the way those are audited today could similarly be applied to these types of measures as well.
Thank you. So you're saying the auditors wouldn't be the ones saying, oh, this is a good measure to have or not to have, but rather, providing assurance that actually the statements made about these measures are right and correspond to what entity has disclosed, and that all disclosure requirements have been met. Is that
I don't think I could say it much better than you just have. That's correct. So
yeah,
absolutely not trying to create a judgment about whether they are good or bad measures, but factually whether they have been calculated and are transparent in the way that the disclosures require.
Yeah, it's quite an important point, isn't it? Because there has been, we had lots of questions around this of what we expect to happen in practice. So yeah, one question has come in, and this is again something we hear often: interaction with regulatory guidance. And this question in particular talks about ESMA's guidance on APMs, but we know other regulators have their own guidance. Do you want to maybe talk us through that interaction a bit?
Sure. Well, we know there are some differences, as there are differences between different regulators in different jurisdictions. And in the development of the management performance measures, we did speak quite frequently with regulators and to try and make sure that we had a baseline that is at a minimum what other regulators require. Now, we know, for example, with ESMA that we differ particularly in scope. As I mentioned, this is only a subset of the types of measures that would be included within the scope of the APM guidance for ESMA. We also have some additional disclosure requirements that aren't there. One notable one is the requirement for the tax and non-controlling interest on the reconciling items, which I mentioned.
Thank you so much. So the regulatory guidance very much remains relevant, right? Especially because our scope is limited to what is the focus of this project, which is income and expenses and statement of profit or loss. Related question, and you just mentioned the ESMA, and similarly, I think other regulators do not go to the extent of detail with disclosure of tax and NCI as the IASB has in the exposure draft, and the IASB is intending to keep those proposals to meet user needs. But can you maybe talk us through why the IASB is continuing with these proposals, whereas there's no proposal, for example, to determine tax and NCI on individual line items or the categories in the statement of profit or loss?
Sure. So I think there's two main reasons. One, of course, is to make sure that the information is transparent. So once we step outside of the framework of IFRS, as we can with these types of measures, it's very important to make sure that we are as transparent as we can. So that's one objective. The other is throughout the development of these proposals and through the redeliberations, we've heard a consistent message from users, which I explained earlier in the presentation, but that the information about tax is extremely important to their analysis, particularly on the line items. They've mentioned that tax impact can be significantly different, and significantly different than the average rate for the entity. But they also like to analyze these measures by including or excluding particular line items and then take that to a per share measure. And the IASB decided that this was an important user demand to meet, and to do that, we require the tax and NCI.
Indeed, users are very keen to have this information, aren't they? So with that, Nick, I do note that we have a couple of questions we haven't answered, but I suggest we come back to them if there's time at the end. And now is the time to hand over to you, Juliana, to walk us through a range of things the IASB is doing on disaggregation.
Thank you, Aida. So now let's spend a few more minutes on disaggregation. So what is the issue? Part of the feedback that we received at the start of the project is that sometimes information in financial statements is too aggregated or incomplete, and users don't get the information they need for their analysis. Now, the proposals for subtotals would already improve disaggregation by providing more structure and reference points for users' analysis in the statement of profit or loss. This, together with the MPM proposals to complement subtotals, are key proposals to deliver the project objective. So what will be the disaggregation requirements? In addition to the key proposals on subtotals and MPMs, the IASB has developed a set of general as well as specific proposals to strengthen the requirements for disaggregating information, covering both the primary financial statements and the notes. So now let's look at the general requirements in a bit more detail. First of all, the IASB is proposing to introduce principles about the roles of the primary financial statements and the notes. These will clarify, for example, that the role of the primary financial statements is to provide an understandable overview of an entity's income and expenses or assets, liabilities, and equity, which will then help entities decide which line items to present in the primary financial statements and which to disclose in the notes. Secondly, the IASB has developed principles of aggregation and disaggregation to help companies determine how to group information. Those principles focus on identifying differences in characteristics of information that may mean a particular grouping of information would provide material information to users. Specifically, items would be disaggregated if the resulting disaggregated information is material. Now, with regards to the specified line items, the IASB has confirmed the proposal in the exposure draft to add to the specified line items a requirement that goodwill shall be presented separately in the statement of financial position, which many entities already do today. In addition, the IASB has developed requirements to ensure entities use meaningful labels to describe items and to use labels such as other expenses or other liabilities only when necessary. So now let's look at how the concept of specified line items interacts with providing an understandable overview. An entity would disaggregate items in the primary financial statements when such disaggregation leads to an understandable overview being provided. With regards to the notes, an entity would disaggregate items when the resulting disaggregated information is material. So it is important to note that although all items presented in the primary financial statements are material, not all material items might be presented. This is because presenting all material items might not provide an understandable overview of the primary financial statements, and an entity might need to aggregate some items in order to achieve that understandable overview. Now, with regards to the specified line items, these items are presented in the primary financial statements only when presenting those items does not detract from providing an understandable overview. Specified line items that are not presented would be disclosed in the notes if this provides material information. So now let's move on to the two specific proposals for disaggregation in the notes. The first being the disclosure of operating expenses by nature in the notes. Now, with the requirements relating to expenses classified in the operating category of the statement of profit or loss, the objective was to strengthen the requirements on presentation and disclosures of operating expenses, focusing on expenses by nature, such as staff costs, depreciation or amortization, and expenses by functions, such as cost of sales, selling, or R&D. In the exposure draft, the IASB proposed that entities should present operating expenses by function or by nature. The IASB wanted to clarify that the presentation method is not a free choice, so entities would need to consider a set of factors to determine which presentation method is the most useful. Now, while the exposure draft proposed that entities should not mix by function and by nature, the IASB has meanwhile withdrawn this proposal. So, for example, to allow entities to separately present impairment of goodwill, even when other operating expenses are presented by function. Now, what this slide focuses on is disclosure requirements regarding operating expenses by nature. The exposure draft proposed that entities that present operating expenses by function in the statement of profit or loss also disclose an analysis of total operating expenses disaggregated by nature in the notes. However, the feedback from preparers was that this would be too costly for some entities. So, to achieve a more balanced outcome between cost for preparers and benefits for users, the IASB has tentatively decided to require an entity to disclose the amounts of depreciation, amortization, and employee benefits included in each line item in the statement of profit or loss. We plan to explore in targeted outreach whether to expand this disclosure requirement, so as to also include impairment and write-downs of inventory, or whether to expand this disclosure requirement into a general requirement. A general requirement would mean an entity would disclose for all operating expenses disclosed in the notes the amounts included in each line item in the statement of profit or loss. The IASB has yet to finalize the exact scope of these proposals, but in any case, an entity would only be required to disclose information on expenses that it already discloses as a total. So unlike the proposal in the exposure draft, it would not require entities to disclose information on expenses that are not disclosed today. So now let's move on to the proposal for unusual income and expenses. The proposed disclosure of unusual income and expenses has been a challenging issue for the IASB. The reason the IASB has been working on this is because many entities currently disclose non-recurring, unusual, or similarly described income or expenses. Users often tell us such information is helpful for forecasting future cash flows. However, users currently have to rely on voluntary disclosures and have expressed concerns that the way entities provide this information varies significantly. So, for example, it is often not clear why items have been identified as being unusual, and there is a bias towards identifying expenses as unusual and not income. In the exposure draft, the IASB proposed a definition of unusual income and expenses. If an item of income or expense would meet the definition, an entity would disclose additional information about that item in the notes, such as giving a narrative description of the transactions and events that gave rise to that item being identified as unusual, and disclosing the line items in the statement of financial performance in which the item is included. There was strong support from stakeholders for the IASB to develop a definition of unusual income and expenses. However, the feedback we received was also that the definition is too subjective and that it includes income and expenses that some do not view as unusual. Now, although most disagreed with the proposed definition, there was no clear consensus on an alternative definition. In light of this feedback, the IASB has been working on a revised definition of unusual income and expenses, focusing in particular on reducing the subjectivity and limiting the population of items captured by the definition. However, the discussions with stakeholders and IASB members over the last 9 months have not led to a consensus on what the population of unusual income and expenses should be. Hence, the IASB has now tentatively decided not to proceed with any specific requirements for unusual income and expenses in this project. It is, however, important to put this decision in context. The proposals in the exposure draft on unusual income and expenses relate to disclosure only. They do not affect the classification of income and expenses in the categories of operating, investing, and financing. And in particular, unusual income or expenses cannot be presented as a separate category in the statement of profit or loss. Further, we think the potential loss of information caused by the IASB discontinuing the proposals is mitigated by the disclosure requirements for management performance measures for reconciling items, and the general requirements to disaggregate amounts when the resulting information is material. We think financial reporting will be better improved by moving forward on a timely basis with the key requirements on the structure of the statement of profit or loss and management performance measures, rather than risk delay of these aspects of the project by pursuing potentially fruitless definitions of unusual income and expenses. I will now pause here for questions on disaggregation.
Thank you so much, Juliana. You've covered a lot of ground here. As you can see, we've been very, very busy for the past year and a half and so. And some of the questions have come in, again, a bit similar to questions this morning. So there's clearly a trend here. And one is dealing with the expected effect of these proposals on the line items that entities will present, in particular in the operating category. So do you want to talk us through in terms of what changes we might expect to see as a result of these proposals?
Well, I guess for the specified line items in the operating category, we would generally expect that presenting these line items would lead to an understandable overview being given. But I guess then, again, it depends on the specific situation of the entity.
Indeed, and there's quite a bit of nuance here, isn't there? So, for example, the IASB has decided to retain its list of required line items, but we have added a top-up where we explain relationship with the roles of primary financial statements and clarify that these required line items are presented only if it does not detract from that role of providing understandable overview. And this may lead to a change as well for, as we know, there is some required line items that perhaps relate to transactions that are not so important for understanding performance in some industries or for some entities, and they may conclude that actually presenting those does detract from understandable overview, will not present them. But it's also important to note what you said earlier, that this would still constitute likely material information that would be disclosed. So the fact that they wouldn't present something doesn't mean that the disclosure would not be provided there. So it's a quite nuanced, and we suppose the effect will be quite entity specific, and there may as well be many entities that there may not be changes in terms of the line items apart from classification differences that we've discussed. So there is one question, well, few actually come in relation to the proposal that maybe we discussed most together with unusual income and expenses, and this is in relation to analysis of operating expenses by nature. So the question is that if so not proceeding with requirement to provide analysis by nature, does that mean that if entity is not disclosing that today, it would not disclose such information going forward either?
So generally, with the tentative decision that the board has made now for depreciation, amortization, and employee benefits, an entity that, and we know that other standards require, for example, disclosure of depreciation and amortization, would have to give that link to the line items in the statement of profit or loss. So these amounts we would expect would appear in the notes, and an entity would be required to disaggregate those totals and provide that link to the statement of profit or loss.
And maybe if we continue on that theme, because on the earlier side you talked about the IASB has already tentatively decided that, you know, only depreciation, amortization, employee benefits, and potentially addition of impairments would be the items by nature that are already required to be disclosed, where entities would need to provide a relationship. But the IASB is also in this targeted outreach exploring making this a general requirement. Could you talk us through the effect if the IASB were to proceed with general requirement? What are the additional type of things that investor would see and companies would provide where this information would be given for?
Yes, well, the general requirement would pick up basically all operating expenses that are disclosed in the notes. So that could be, for example, any fair value gains or loss on derivatives. That could be FX gains or losses, for example, variable lease payments, restructuring expenses. So that it is very, I mean, to some extent, of course, standards require specific disclosures. They would be picked up anyway, and then if an entity would disclose other items in the notes, those would also be picked up. For users, I guess the benefit is, of course, always knowing how these items that are disclosed in the notes, these expenses, how they relate to the line items in the statement of profit or loss. And I think where the board is at the moment is kind of figuring out where is the right balance of costs for preparers, of course, and benefits for users.
Thank you so much. So this balancing is a constant exercise, is it not? You know, how we give enough useful information, but don't go overboard with imposing costs on preparers. Now, Roanne, if I can come back to you, because we had a question come in that we didn't have a chance to cover when we talked about subtotals, and I think it's again one of the popular questions we get in meetings, and it is about where would entities classify gains or losses from disposals of businesses, and would you like to talk us through that?
Yeah, sure, Aida. So this is obviously a question that we're frequently asked about, and an entity would assess whether or not the income or expense, so the disposal gain or loss, whether or not that meets the requirements to be in the investing and financing category. Generally it would not. So then by default it would be classified in the operating category. We have had in the feedback from the exposure draft questions around step up or step down type of acquisition. So like a financial asset becomes a subsidiary, or a subsidiary becomes associate and joint venture. At those points of time when the asset switches, what do you do with those gains and losses and things that arise at that point in time? And that is actually something we're going to explore in a future paper, whether or not we need general guidance or further guidance around what you do when you classify an asset and the income and expenses will switch which categories. So that's something to stay tuned on for a future board paper.
Thank you so much, Roanne, and you gave us a good flavor of, you know, there's, whilst we covered the main proposal, there's still quite a bit in the detail that the IASB has to work through in before it finalizes redeliberations. And I will maybe just cover a couple of more questions, or, you know, one or two. One back to you, Juliana, cost of sales, you know, commonly presented line items mandatory now with presentation by function, but one that IASB does not define in great detail. So why did the IASB decide to not provide guidance on cost of sales?
Well, it's a very good question. The IASB has tentatively decided not to define cost of sales as part of this project because it would be difficult to develop a definition within a reasonable time frame, and undertaking such work would delay the completion of the project, which we of course don't want. However, the IASB has tentatively decided to require that at a minimum, cost of sales would include inventory expense. Now, this might seem to be stating the obvious, but we have observed that some entities exclude components of inventory expense when presenting cost of sales. What the IASB has done is that tentatively decided to require that an entity shall give a narrative description of the composition of functional line items, such as cost of sales. And this will help users better understand the composition of that functional line item and whether the functional line items are comparable across entities.
Thank you so much. And, you know, it's good to know that although we are not doing a whole project on it, there are proposals there that will at least improve communication, if not comparability of the item itself, so that users understand what is included and what is not, which, you know, we hope will be useful. We are running out of time. I will just quickly take the final question because the answer is easy. What is the effective date? And the answer is we do not know yet. But just to recap what I said at the beginning, so the next steps are targeted outreach over the next few months, going back to the IASB with findings of that targeted outreach early 2023, and then proceeding to finalize redeliberations on all outstanding issues like the one Roanne mentioned, for example, and then we will go into the drafting. Those of you familiar with our processes, no, drafting is not a quick press the button and here comes the standard, but there is a number of processes involved to make sure we have a good quality product out there at the end. And with that, I just want to thank you all. Thank you first, Roanne, Nick, and Juliana for time today. And thank you to our stakeholders who have yet again taken time to join us on this journey. And I know many of you have been with us from beginning or even from before 2015 in previous iterations. And I just want to thank you for your continued engagement and support and enthusiasm for this project. We can't do this without you. And with that, I'm going to wish you all a pleasant evening and a wonderful weekend. And thank you very much again.